Hello to our annual followers. This time in today's podcast, we will speak about what macroeconomics are. We will study all macroeconomic variables and models. As you can know, these are the Keynesian model, focus on the short run, classical model that focus on the medium run, monetary policy for the long run, and finally the solo model for the very long run. Firstly, we'll start by introducing the key variables that affect macroeconomics, that are the GDP, unemployment, inflation rate, interest rate, stock market, and also the exchange rate. The first one, the GDP, also known as the real gross domestic product, shows the values of goods and services that's produced by an economy in a given year adjusted for changes in the price level inflation. The real is the adjustment for inflation, gross, the value of the obsolete things and also the investments. Domestic because it's for just one country, and product because also the final product produced in the country. The GDP is made of consumption by individuals, the total government expenditure, investment expenditure by firms, and the net value of exports. Also, the GDP deflator is used to measure changes in the GDP from one year to another. Now let's think to the following variable, that is unemployment. Unemployment is a variable that measures the amount of people, the active population that are looking for a job and don't actually work because they don't fix in any job.
And what happens if there is no unemployment?
Okay, that's a good question, because a society without unemployment it will be very inefficient, because if you enter in the first job that you're offered, you can develop yourself in the best way, so you can report the society your best. Okay? Fine, let's follow with the inflation rate. The next variable is so easy, because inflation rate is just the variation of prices in the year. Following will be the interest rate, that is the percentage to borrow money, or also the percentage income from savings. We can measure in nominal or in real terms, and depends on the duration. If has more duration, will be a higher interest rate. The risk, with more risk, more interest rate, and then the tax treatment and the fixed nominal or variable real.
And what happens if the interest rate goes up?
Okay, if the interest rate goes up, the problem will be that investors will decrease, because business who are willing to invest a huge amount of money will pay more for borrowing that money, and the other way, if investments are low, will pay less for borrowing that money, so investments will increase, and if interests are high, as you had asked me, investments will decrease. Satisfied with your answer?
Yes.
Yeah. Okay. Then the stock market variable is the share representing portions of property of corporations are traded. It's the market where corporation or shares of corporation are traded. It's as simple as that. And finally, the exchange rate variable is the rate at which currencies of different countries are traded. If a currency appreciates against other, gets stronger in real terms, and if it depreciates, gets weaker. And with this, we'll conclude the 6 key variables of macroeconomics. So let my partners follow the speech.
Thank you. So I'll be discussing economic growth, and I'll talk a bit about the marginal product of capital and the production function. So what's economic growth? It can actually be defined as like an increase in the living standards, or it can be expressed in a percentage to see what kind of growth a certain indicator has made. And you calculate this by using the year before and the year now. So basically it just measures the change from one period to another.
And can you calculate this solely on a yearly basis?
No, you can do this monthly, quarterly, yearly. It's whichever you want, actually. And to calculate the growth rate, you have to use a formula, which is quite easy. You just use new min old minus old divided by old times 100. And this can also be at a constant rate, but the constant rate basically means that the growth stays the same over the next years, and this will give you like a linear line when looking at graphs. Though, to be honest, this is not really possible for growth like to stay constant all the time, and besides like the normal growth and the constant growth, you can also calculate the annual growth rate. This kind of is a variation of the growth rate, and it's often used to assess performances. So in economics, we use models to give mathematical representations of some kind of hypothetical world that we use to study phenomenons. So a model is basically a set of equations. I'll briefly talk about what the production function and marginal product of capital are. So first, the production function. This is just a function that tells you how much product can be produced if the amount of labor is combined with capital.
Where would you use this function?
Well, the function just helps making short-term decisions, and you can use it to find out what your best level of output is.
And what about long term?
Well, in the long term, it helps with deciding the production level. And like all in all, it just helps to calculate how low firms can make their costs. They will do this by using various combinations of the function, and the production function just looks at the total numbers. So what if we actually want to look at the marginal product of capital? This one shows the extra amount of output produced when 1 unit of capital is added.
But if there is a marginal product of capital, is there also one of labor?
Yeah, sure, there is. They're basically the same, just the capital is replaced with labor in the formula.
So I'm going to be explaining a bit about some of the macroeconomic models. And the first macroeconomic model that will be explained is the sticky price income expenditure model, also known as the Keynesian model. This short-run model determines current output and current inflation. In the short-run model, the current level of output and inflation are endogenous. The current output deviates from potential output because of economic shocks. We assume the long run is given. And potential output and long-run inflation rate are exogenous. In this model, prices and wages are rigid. There's no need for full employment as not all resources are being used, and there is a relevance of demand. The short-run model is based on 3 premises. The economy is constantly being hit by shocks being the factors that cause fluctuations. Monetary and fiscal policies affect output, so policymakers can neutralize shocks to the economy, and there is a trade-off between output and inflation. This is shown by the Phillips curve. However, the classical flexible price model is quite different and affects the long run. In this model, prices and salaries are flexible and there is full employment, meaning there is equilibrium. Instead of relevance of demand, which we saw in the short-run model, there's relevance of supply, and this model guarantees 3 things: that current production equals potential output, that there's full employment, and that markets work.
But Safia, how are these 2 models different? I don't understand. Could you use an example, please?
There are quite a few differences between the 2 models, and I'll use the example of autonomous consumption to compare the 2. In the flexible price model, a fall in consumption means an increase in household savings. The total savings curve would essentially shift to the right in the movement of funds diagram, and the real interest rate would fall and the equilibrium level of investment and net exports increases. In this model, the consequences of a fall in consumers' desired baseline consumption would be a drop in consumption, an increase in household savings, a decline in the real interest rate, a rise in investment, and a rise in the exchange rate because the currency depreciates, and as we know, the interest rate and exchange rate are inversely related. We would also see a rise in net exports because of the currency depreciation, and therefore a fall in foreign saving, as the foreign countries are spending more on our products. However, now we will see the difference between the 2. So if we use the same situation, a drop in consumption but with a sticky price model, it will lead to a drop in aggregate expenditure, which is the demand of goods and services. So since demand has fallen, businesses see spending on their products falling. They do not respond by diminishing prices because remember, prices are sticky. So instead, they have to cut back production. They want to avoid stockpiling of unsold and unsellable goods. Also, when decreasing production, they'll probably fire some of their workers, and this would lead to the income of those fired employees decreasing. So unlike the classical model, in the sticky price model, a drop in consumption does not lead to an increase in savings. The increase in savings from the fall in consumption is exactly offset by a decrease in savings from the fall in income. The real interest rate is unaffected, and there is no change in investment or net exports. In the sticky price model, the consequences of a fall in consumers' desired baseline consumption are a drop in consumption, a decline in production, also a decline in employment, and a decrease in national income. There would be no change in the real interest rate, investment, or exchange rate.
I have heard before of a multiplier is related to this. What is the multiplier?
The multiplier process is actually quite simple. If prices are sticky, a higher planned expenditure boosts production, as this production is income that goes to someone. Remember the circular flow of economic activity, so income rises. High incomes give a further boost to production, which increases planned expenditure even more. Just as in the expansions, the multiplier effect causes an upward spiral, but also in bad times, the negative shock is also amplified, because those who have lost their employment also reduce their spending. Therefore, a tax system that provides stability to the economy is required. In the multiplier process, the fundamental consequence is created by those spending components that depend on income. The increase in income caused by the increase in aggregate demand further increases aggregate demand, and this increases the aggregate demand even more, and so on, until the end of the whole process and a new equilibrium is reached. This is the multiplier effect, and you can calculate it through dividing 1 by 1 minus the marginal propensity to expend. The next topic I will talk about is planned expenditure, and planned expenditure actually has 4 components: consumption, investment, government spending, and net exports. Aggregate demand is the desired or planned expenditure, and that is the demand for goods and services produced within and by economic actors. As long as the prices are sticky, the level of real GDP is determined by the level of planned total expenditure, not by the level of potential output. So Y is equal to PE.
Okay, now I'm going to explain the solo model, that it's the last model to explain. It's a dynamic model of economy that studies the consequences in the very long run. We have seen the previous models, and now we're going to finish with this. It explains how the economy changes over time as savings and investment, the growth of the labor force, and technological process and social organizations improve. Its main keys are the labor productivity that increases or decreases when the 2 variables that are efficiency of labor and capital investment change.
Can you explain those ideas, please?
Yes, the efficiency of labor is a variable that measures the productive capacity of a worker to do more or better work, or both, during a specified period of time, while the capital intensity is the amount of fixed or real capital present in relation to other factors of production, especially labor.
And how do they change, or how do they affect the economy?
The efficiency of labor rises because there are advances in technology or in organization. For example, if the labor force in an enterprise is better prepared or the technology is more advanced, they will perform more efficiently. While speaking about the capital investment, it has a direct relationship with productivity. If the capital investment increases, productivity will increase too. There will be less employees, but the wages will be higher.
So now, on to the big question. We're always talking about money in economics, but what actually is it? So money is wealth that's held in a readily spendable form. It represents wealth that can be used immediately to buy things, as vendors accept it as a medium of exchange or payment. It could be made up of coins and notes, checking account balances, and saving account balances. It has 3 functions. It serves as a means of payment, it's used as a unit of account, and it is a store of value.
What would the world be like without money?
Without money, market transactions would have to be performed through barter or exchange. So in a barter economy, market exchange would require the coincidence of wants. This means that you would have to have a good or a service that another person wants, and that they would have to have a good or service that you want, and then you exchange. Anyways, in the Eurozone, there are different monetary aggregates: M1, M2, and M3. M1 includes cash plus current accounts, demand deposits, saving deposits, and other deposits, for example. M2 includes other assets that can be converted almost instantly without risk or cost in cash or deposits. And M3 includes everything in M2 plus very other liquid actives. So the types of deposits you can have include demand deposits, which are those that can be removed or admitted by the depositor without penalty and are implemented in current accounts. You can have saving deposits, which are those that can be removed or admitted by the depositor without penalty and are instrumented in passbooks, or term deposits, which are made for a period of time, for example, a month or 6 months or several years even, and until maturity does not occur, depositors cannot withdraw their funds. So in terms of cash reserves, the lending activity of banks consists of obtaining deposits, paying interest and grant loans and credits, charging higher interest than paid on deposits. Through this activity, banks have the capacity to actually create money, as out of all of the deposits received, only part of them are held in cash, and this is to meet possible demands of money from their clients. This cash that banks hold, in addition to the deposits at the central bank, are called bank reserves. The amount of money the banking system generates with each euro of reserves is called the money multiplier, and this is actually the inverse of the cash reserve ratio.
Is there an determinant of the demand for money?
Yes, the flow of spending. The flow of spending is a very important determinant of the demand of money. Let me introduce you to the quantity theory of money, where MV is equal to PY. So remember, in the flexible price model, real GDP is equal to potential output. PY represents the total nominal flow of spending, M is the money stock, and V is the velocity of money. An important policy governments take to control the flow of spending and inflation is monetary policy. Monetary policy is defined as the actions of economic authorities, central banks usually, aimed at controlling variations in the amount or cost of money in order to achieve certain objectives in macroeconomic nature, for example, to maintain stable prices. The determination of the money stock is the basic task of monetary policy, and the Federal Reserve can directly impact the monetary base, the sum of currency in circulation and deposits at the Federal Reserve. To reduce the monetary base, the Federal Reserve sells the short-term government bonds and in turn accepts cash or deposits. To increase the monetary base, the Federal Reserve buys short-term government bonds and pays them in cash or writing deposits in the account the corresponding bank has in the central bank. And these transactions are called open market operations. Another important concept is purchasing power parity, and it's the result of generalizing the law of single price to the international market. The exchange rate that allows a euro or any other currency, for example, to achieve the same purchasing power in all countries. This is also known as the Big Mac Index, and it's used by dividing the price of a Big Mac in one country by the price of a Big Mac in another country in their local currencies to arrive at an exchange rate. This was interestingly named Bergonomics.
Okay, now to give a different view to the end of the podcast, we are going to speak a little bit about the financial crisis, which is related to macroeconomics too. Financial crises are periods of time when prices of stocks and other assets fall, and everyone is at the same time trying to transfer their wealth to safer assets. The main consequences are the panic among investors, because if one group of investors start selling their assets because they think they are risky, all the others start to, and this leads to capital fights, and this is what causes stock prices and real estate to fall a lot and interest rates to climb. This reduction in investment is worse because it plunges the economy into a deep depression that could be avoided if the investors didn't panic so much. Which is the role of the central bank in this case? they need to increase the money supply because all people wants to have more liquid assets. So they need to increase these assets, and for this they decrease the prices of the prices, not the prices, but the interest rates. The central bank works as a lender of last resort too, so they reduce risk premiums and temporary bonuses, and they need to guarantee deposit insurances, otherwise the depression aggravates. And this way, if a bank fails, the government guarantees deposits not to disappear. Which is the moral hazard here? That as depositors know someone will always save them, they will risk a lot. And this means that they won't be like trying to do the best way, the things the best way, but will know that if they fail, the central bank will then give the money to the people and so on. So as a conclusion, they give resort only if there is a proper supervision and monitoring. And now to speak out the crisis that we have seen, like we have lived, we are going to speak about the Great Recession, that is the financial crisis of 2008. It started in the summer 2007 because of the subprime mortgage crisis in the US and a collapse of the investment bank of Lehman Brothers. The causes were that the housing prices started to multiply 3 in a period of 10 years, and this created the housing bubble. And then in 2006, suddenly the housing prices plummeted by the 36%, so the bubble burst. The global savings abundance was another cause because of the excess of savings in developing countries, and that they used savings to buy assets. So the demand for the US assets increased a lot, including the stock market and the housing market. The third cause was the subprime lending and rising interest rates because of the mortgages used to buy homes, the low interest rates, and the subprime borrowers that had poor credit records and high debt-to-income ratios. And the last cause were the oil prices that were extremely volatile, and as they were unstable, this caused also the inflation to be really volatile, and this price increase was caused by the excessive demands from China, India and Middle East. So there were short-term supply disruptions. The recession's first visible consequence was unemployment, and by 2009 the output was 7% below the potential, and the unemployment was more than the 10%. And by 2010 the unemployment was more than 8.5 million people lost their jobs, so it was quite difficult. And now we have Xavi here. So what do you remember about the crisis, Xavi?
Well, I can slightly remember how people were worried about the consequences of the crisis. For example, they lost of their jobs and other things related. I remember I didn't understand what crisis was, just that everybody was concerned about it. For me, the hardest thing was staying at home with no holidays for 3 years.
Okay, so thank you very much to our listeners. Here we finish our podcast, and we hope you have understood something more about macroeconomics. Goodbye.
Thank you. Bye.
Well, pero no pasa nada. Es mejor eso que morirse. So, thank you all. I stop the video here.